The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A tinge of market optimism, or was it all simply a short squeeze? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. I was going to call it a dead cat bounce.
Oh, no.
I can't even call that a dead cat bounce anymore. Because we're not going anywhere. We're not bouncing at all. The S&P is only up by about down by 0.5%. We are really rolling over here in the last hour of trade. Just look at the Russell Transportation Index as well as tech. VIX picking up to 50. One of the highlights, Romaine, that we will talk about throughout the show is what's happening with dollar and the offshore yuan here, hitting a record high as we constantly have China now moving into the market as we escalate those trade wars. And the 30-year yield up 9 basis points, remain 33 basis points higher in just 2 days for that long end. Yeah, the moves really cross-asset-wise, quite frankly, are just absolutely breathtaking once again. It looked early on in this session like the market had finally gotten a reprieve from 3 brutal and wild days. The S&P staged a massive gap up at the start of trading. That's the difference, of course, between where the index closed yesterday and where it opened today. That gap, 131 points, the widest on record. That surpassed the gap higher on November 10th, 2022, when the market rallied 6%, and it surpassed the March 24th, 2020 gap up when the market surged 9% after the COVID-induced sell-off. But here's the thing. The dip buying in the morning today, it faded by midday, and it really speaks to some comments that a lot of folks have been making here on Bloomberg television. Goldman's Tony Pasquarello doesn't actually think that price-to-earning multiples had actually reached the nadir that he would expect to see in a true sign of capitulation. That sentiment shared by a lot of folks. In his view, he's saying that the probability of indiscriminate short-cycle rebounds, that's high. However, that's likely to be met by the higher probability of sell-offs, particularly with the economic outlook still cloudy.
I think it's more likely than not that we're going to have a recession. We're very likely, in the context of a recession, to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems.
And strategists from Barclays to UBS and everything in between note that right now the key risk for investors is overnight tonight into Wednesday. Don't forget, that's when a lot of those Trump tariffs actually do kick in. On top of that, you get the start of earnings season with Delta Airlines tomorrow morning. You scared?
Yeah, definitely. And the reason why is because we've seen a re-rating of earnings estimates just in the last few weeks. And the question is it enough? This is a great analysis from Bloomberg Intelligence that shows that earnings expectations for the first quarter back in January were about 11% for growth. Now we look at where we are right now. We're about 6.7% for that first quarter. So a big re-rating. This would be potentially the first earnings miss since 2020 and the weakest increase in about a year. And that's not even taking into account margins as well as profit. In fact, remember, we're looking at margins still in the 15 percentile. Does that have to be re-rated even more as tariffs continue to kick in? If so, how do you possibly buy any kind of dip?
Yeah, that is the question here. And certainly the moves we saw early in the session had a lot of people scratching their heads as to exactly what people see that maybe others don't. Jim Bianco joins us right now. He's the president over at Bianco Research, kicking us off to the close. And Jim, I mean, you saw that dip buying. We saw it yesterday for like 15 minutes. We saw it today, and it seemed like it was lasting for a while. But I'm not quite sure what exactly is giving people the optimism that somehow the worst is behind us. Do you think the worst is behind us?
No, it's still open in the air. And I think that dip buying you saw, that's why it didn't hold, is it was a bunch of short covering, as you said, and a bunch of speculators. And then they all looked at each other and said, no one else is showing up. And then they all turned around and they got right back out. I also think the other problem that's happening with this market is the disappointment in the Treasury market. Sure, it's rallying, but you just had Larry Summers on talking about recession. Goldman's talking about recession. JP Morgan's talking about recession. You had the earnings numbers down. You have the stock market down 20%. The 10-year yield was 360 last September. It should be 325 right now. It shouldn't be 425. So there's a real, disappointment that we're not seeing any relief from lower interest rates. And I think that's because inflation is a real problem, which is what Jay Powell said on Friday. He's now going to be slow to cut rates because he's worried about inflation.
Yeah, and it's kind of interesting, too, when you talk about the uncertainty in the market. We talked a lot yesterday about volatility, equity volatility, still elevated. But when you look at volatility in the Treasury space right now, Jim, I mean, whether you take TLT or one of the other measures out there, we're like 90 to almost 100% above recent averages.
That's correct. I mean, there is a tremendous amount of volatility, not only in the Treasury market, but in all markets. You know, the VIX is at 50. The MOVE index, which is kind of the bond market's VIX, is nearly 140 on that index, which is extremely high. So you've got a lot of skittishness in these markets, and it's also leading to people talking about things like the basis trade is unwinding, leverage traders are being forced out. And I would just say in general, typically when you see wild movement like this, too many people on social media like to say who's making profits on this? Nobody. Most people are losing money on this. The better question is ask, is anybody blowing up? Is a better way to think about it than who's making a profit.
Are they? Is anyone blowing up, Jim?
Not that we've heard, but you know, we're not done with this move yet. And I'm sure that there are a lot of people that are looking at their P&Ls and they're not very happy with what they've seen in the last week or so. But I don't know if it's gotten to a crisis level individually at any particular firm.
But when you continually have sort of the dollar weaker, bonds selling off, higher yields on the back end, and equity selling off all at the same time, and a spike in the VIX, how long does that last for before we see some real strain?
Oh, I think you're talking about days or a week or two. I mean, we can't live like this for much longer without there being some real strain either in the economy or in the financial system of some time. The financial system, by the way, is so complicated, it's impossible to tell where it's going to show up. But, you know, since I'm talking to Bloomberg, there'll be a red head somewhere here in the next 2 weeks if this doesn't slow down. And I suspect it will slow down, but if it doesn't, that's what you'd be looking for.
What is the reprieve, though, Jim? I mean, when we talk about the idea of sort of what arrests the sell-off, and not just arrest it, but really what helps the market sort of, if not get back to where it was over the last few weeks, certainly to reclaim some of those losses. Is it some deal that Trump strikes with some of these various nations on trade? Is it more clarity on the economic front? Is it the Fed stepping in? What does the market need to see?
I think it's a trade deal. I don't think you're going to get clarity on the economic front. The Fed's not going to step in until they see signs that inflation is coming down. I think you need a deal that provides a roadmap. Here's how we're going to deal with, you know, this situation. Country X did it this way. Now the rest of you, let's follow that model and see if we can get some deals together. Until we get that, I think we're going to stay the way we are right now. And hopefully that deal is hours, if not a couple of days away. And that would be the hope right now.
That would be the hope. But, Jim, that's pretty fast. I mean, we're talking about a president that in, you know, the 11, 12 weeks he's been in office has done things that under previous presidencies, including his own, took like a year and a half to get to in terms of implementing tariffs. I mean, how do you even negotiate at that type of speed?
Well, you know, that's a good question. I mean, I don't think you could tell this market that we're going to leave these tariffs in place and leave the situation as it is for a year or a year and a half while we negotiate some kind of version of the GATT, version 2.0. That's the General Agreement of Tariffs and Trade that was negotiated, a couple of decades ago that really set the stage for modern globalization. Yes, but you set this up in a crisis atmosphere with these massive tariffs. Look at China. We got, as of a couple hours ago, with 104% tariffs with China. How long can we continue to go like this? If the answer is we're going to go like this through the rest of the year and into 25, then these markets, this is going to be the way these markets are going to be for the rest of this year.
Yeah, and the Chinese premier just speaking just a while ago saying China is equipped to fight, Jim. Got to leave it there. Jim Bianco, president over at Bianco Research. Another volatile day on Wall Street with stocks now hitting session lows after being higher by as much as 4% on the day. We are waiting to hear from the president of the United States, who has promised to sign an executive order related to coal. We're going to discuss what's next for America's energy market with Samantha Dart, co-head of Global Commodities Research within Goldman Sachs' Global Investment Research Team.
And speaking of the White House, a broad-based discussion with Scott Bessent's right-hand man. We're going to get a chance to sit down with Michael Faulkender, Deputy Secretary of the U.S. Treasury, coming up later on the show.
And we're going to talk to the legendary economist Carmen Reinhart to talk here about the tariffs and the impact on the global economy, not just the response by those nations, but maybe the retaliation to the retaliation. A lot to cover. Don't go anywhere. This is The Close on Bloomberg.
Oil falling solidly under $60 a barrel. We're now at 58 for WTI as those trade headlines really pick up the whole market rolling over. Here with what's next is Samantha Dart, co-head of Global Commodities Research within Goldman Sachs' Global Investment Research team. Samantha, what could be a good floor for oil prices right now?
So it's really a macro story, right? So it will depend on how bad things get from an economic growth standpoint. We last night put out a few scenarios discussing exactly that. And let me start with the baseline. So the baseline is that some of the tariffs announced are walked back, and we are able to avoid the recession under that baseline. We have a forecast for Brent and TI, very similar to the levels where we are right now. So we would have Brent finishing the year around 62, TI around 58. So not a lot of changes there. But we have to consider the scenario of a U.S. recession. And under a recession, we could be in the high 50s for Brent, which would mean in the low to mid 50s for WTI.
So to that point, though, I'm wondering about the supply side response, because what producers dislike even more than lower prices is the volatility, and the whippiness that we've seen would kind of rattle anybody. At this point, are we going to see kind of shut-ins, production being rolled back, and what's the implication of something along those lines?
Absolutely. I wouldn't necessarily say shut-ins at these levels, because you shut in when your price is really not even covering your operational costs. But to your point, prices are now so low that we think that producers will really question the amount of capex they're going to put on the ground. So if you don't invest, then decline rates set in. And we know that with shale, those decline rates set in fast. So because of the slowdown in economic growth and the downgrading prices that we've put out, as I said, we have 62 for Brent for year end, and we have $58 a barrel for WTI. We now forecast that the U.S. is not going to grow crude oil production over the next couple of years. It's sort of flat to marginally down.
I am curious, Samantha, about some of the other pockets of the commodity space, particularly when it comes to the industrial metals. I mean, we were looking at copper prices, I don't know, just a few weeks ago that were over 10,000. We're now around, I think, 8,600 or so on a 3-month rolling basis. What do you think the net effect of all these tariffs and the trade war, assuming that these things don't get negotiated away over the next few days, what is the net effect on prices? Should we be anticipating an increase?
So this shift in prices that you described, we interpreted exactly as the market shifting from incentivizing production growth to now having to price some cost support, right? If you're damaging economic growth, you're damaging demand growth. And if your demand is not growing, then there is no reason for supply to grow right now, and you go back to a cost support level. And we think that that's below $9,000 for copper.
When you're sort of modeling that out, Samantha, is this based on the idea of a global recession or one that's more confined to just certain countries or regions?
We have to look at everything, but to your point, China demand of copper is much larger than that of the U.S., so we do watch China growth very, very closely.
We're also waiting for President Trump participating in Unleashing American Energy executive order signing event. That's coming up in the East Room, and that's going to be trying to unlock the potential of coal. Even if the government were able to do that, is coal competitive with natural gas?
Coal is now cheaper than natural gas in the U.S. We have had a pretty significant rally in U.S. natural gas this year relative to last, because the U.S. is now exporting so much more LNG. So coal is definitely competitive. When we talk to utilities, they are burning a lot more coal than they were a year ago. Now, the production of coal, while we think that increases this year because there's more demand, because coal is cheaper than gas now, when we take a step back and look at what's happening with coal-fired power plants, they are still on a schedule of gradual retirement. So the more you reduce that capacity, the less you're going to need of coal at the margin. So we wouldn't necessarily expect a resurgence of coal production that would last long term here.
What would change that? Like, what could the government do that could change that?
So we always go back to the data center story. The expected growth to U.S. power demand is staggering, to be sure. And we think this is going to mean that everything is going to be needed. Gas generation is going to be needed. Coal generation is going to be needed, as well as renewables. So to the extent that growth in power demand can surprise to the upside, there is a possibility that some of those coal retirements that we were talking about might be a little bit delayed.
All right, Samantha, great stuff. Samantha Dart, co-head of Global Commodities Research within Goldman's Global Investment Research team. A closer look at a big drop that we're seeing once again in the commodity space, oil, the industrial metals, and waiting, of course, on this announcement from President Trump with regards to coal. Alex.
Yeah, let's take a look at those markets, though, because we are really rolling over quickly here. All 11 sectors are now in the red. We're at 49.67 here on the S&P. A close below a 49.15 would indicate a bear market for the S&P.
It's also the volatility. I mean, we talked yesterday about the big swings that we saw. We're seeing that again here. Apple, just take that as an example. They opened higher by 3%. Its peak on the day was 5%. It is now down 5% on the day. So you're talking about a 10 percentage point move on one of the largest stocks in the world. That's not supposed to happen now.
No, and you take a look at a long-term chart of the VIX on a daily basis and back out 2020. We haven't seen this high volatility on an absolute basis since 2009.
And we should point out the VIX actually came into this day right around 44. It got all the way down to 36. Right now, it's trading back at around the 55 level here. So volatility is still elevated. And a lot of folks that we've talked to here at Bloomberg say they expect that volatility to continue even beyond the next 30 days or so.
Right. And then when do you run into issues and rejiggering? I mean, you look at VIX funds and vol-controlled funds. Have they reallocated for this rise in the VIX? And if not, they're going to have to sell stocks and go to cash. They don't have a choice. And where are we in that cycle?
Yeah, your 10-year yield right at 4.2. And according to Jim Bianco, it should be about a percentage point below that, according to him, if you are modeling in the worst case scenarios. We're going to continue to keep an eye on some of the big individual movers out there, including some of the ones moving on the back of analyst recommendations, and that includes Walgreens. They had earnings this morning. We're going to talk to an analyst behind one of the key calls on that stock when we come back. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, some of the big movers on the back of analyst recommendations. And we're going to start off with AMD. KeyBank actually dropping its recommendation to sector weight, saying that the chip maker risks losing its industry standing as NVIDIA and Intel continue to make strides. The analyst also concerned about AMD's AI business in China, given the threat of additional export restrictions. That stock, which was actually up as much as 6% on the day, now down 6% on the day, and now down more than 60% from its all-time high. Next up, Charles Schwab actually getting an upgrade to overweight over at Morgan Stanley. The analyst making a call and a broad-based note on defensive stocks that could shield investors from a tougher macro backdrop. He says Schwab is among the brokers with more defensive revenue streams and unique earnings recovery potential. The price target set at $76 a share, and those shares up fractionally, but that's a two-day rally, and given the environment, I think investors will take it. Finally, Ralph Lauren, an upgrade to overweight over at Wells Fargo. The analyst saying the recent sell-off makes the stock's value more attractive and also notes the company's strong free cash flow. Nevertheless, you're seeing that stock get caught up in today's downdraft, down about 6%. Let's turn now to the healthcare space and keep an eye on Walgreens. Shares of the company are all over the place today after the pharmacy chain reported quarterly profit that exceeded expectations. Pleased to say that one of the analysts covering that joins us right now here in Studio 2. Elizabeth Anderson is Senior Managing Director and Research Analyst over at Evercore ISI. You have an in-line on the stock and a price target of $11.45. Were you encouraged by the earnings that we got today? Earnings that beat a lot of expectations.
Yeah, for sure. We had a bit better revenue expectations. I think front-end revenues were still down on a same-store basis, but less so than we thought. I think also profits came in a little better, and free cash flow was negative, but less negative than it was at this point last year. So all sort of improvements that we would point to.
What about any outlook here? They didn't really give guidance, right? Because since they're going to be going private, but did they give any insight into tariffs at all or the consumer?
No, unfortunately not. When these stocks go into sort of deal territory, we get less visibility from that. So you're sort of stuck with sort of analyzing trends and underlying consumer sentiment, which has obviously been a big question with both tariffs and consumer sentiment being a very pertinent questions this week.
What do you see as, I guess, the long-term future of this company? I mean, this is a transition story right now, and there's been a lot of speculation, whether it stays a public company, whether it goes private, whether it merges with someone else. I mean, what's your general view as to where the executives and, more importantly, the board want to take this company?
Yeah, absolutely. Nothing in today's report would give me any doubt that the deal is still on track to close, right? I think that, the results were a little better than we thought, so that all points to being closing right on time. They said by the fourth quarter of calendar 25.
So you don't see any disruptions in that given the market?
Not disruptions. I mean, there's still a lot of work to be done, clearly, right? Profitability and the core Walgreens stores that many people here have been to, I'm sure, are basically sort of like just flat, like just break even barely, right? And so we really need to see what can this new management structure do to help improve that over time and really take that advantage of that private structure to restructure the business.
What about CVS? Also got earnings there, maybe a different visibility into tariffs and consumer?
Sure, absolutely. So I think a couple of things. The big thing driving the CVS stock has obviously been the Aetna business, right? We got Medicare Advantage final rates for 2026 last night, which is driving the stock higher today, as well as much of the rest of managed care. It really helps us provide visibility into the business over the longer term, not just this week, this quarter, this month, but into next year as well. And I think it's also a check on the what does maybe Medicare Advantage policy look like under the Trump administration, right? We have rates went up, they reflect some of the utilization trends, which is really what has been driving the stock weaker in 2024 and then helped with the rebound. From the consumer perspective, look, I think script volumes were okay. Prescriptions, people are still getting their prescriptions filled. And I think we'll have some questions on tariffs and how much they can pass through, like many other retailers we've been talking about.
Do they have a lot of tariff exposure?
They have some, right? They have the front end goods like many other retailers do. They will probably be able to pass through some of those. And then the question is that we don't know from the Trump administration yet is how are pharmaceutical tariffs going to come through? Trump has said that he's going to put through a pharmaceutical tariff, but we don't know a lot of the details that we need to know to really get a precise look at some of that.
Elizabeth, great stuff. Really appreciate Elizabeth Anderson, Senior Managing Director and Research Analyst at Evercore ISI.
And I just wanted to point out that chart on the screen, because if you were looking for any bright spot on the day, a 5% bump in one of the main indices that tracks the managed healthcare stocks, I guess that's it.
Well, it also goes to show, too, that just if we are really oversold, it's not going to take a lot to get a really big jump. Now, clearly that move is material in terms of actually benefiting those companies, but yet it's not going to take a lot to get a nice spike. All right, coming up, with tariffs set to take effect tonight, we're going to talk to someone on the inner circle in the White House. Michael Faulkender, Deputy Secretary of the U.S. Treasury, will be joining us. Taking a look at the markets, you got the S&P up by 1.4%. You got the Nasdaq now up by a full 2 percentage point. The VIX spiking again to 253. A little bit of safe haven buying in the front end of the 2-year sell-off in the back end. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Really ugly day now developing within the markets as we're about half an hour away from the close of the trading day. Got the S&P down by 1.5%. All sectors in the red, Romaine.
What's more remarkable about it being down 1.5% is that it was actually up almost 4% on the day here. And you get to this point here as to sort of what exactly is driving the moves up and down. We came into this morning and it looked like this was just purely just maybe some folks looking at valuations, maybe finding some opportunity to buy. Maybe it was a bit of a short squeeze. But then by the time we got to midday, I guess people realized there was no sustainability to it, and then you saw a lot of people start to bail out.
Well, Bank of America had a note out this morning that said that all of their clients, whether it's institutional, retail, or companies, were buying stocks yesterday, right? So if that's the case, then you don't go anywhere with that rally, and then you wind up selling. But the real impact came when we got the news out of the administration that we're going to see a cumulative total of 104% tariffs on China.
Yeah, and it's hard to keep up exactly what the actual final percentage is going to be. I thought it was 50%. Now it's 104%. But the key takeaway here is that it doesn't seem like China is coming to the negotiating table, at least not before tomorrow.
Right.
which is when a lot of these tariffs kick in. And I think that's part of the concern. I think there was some hope, particularly once you saw the news on Vietnam a couple days ago, and then, of course, coming in overnight and having that news that Japan had finally lined up some sort of pathway to negotiation with the Trump administration. But again, you're talking about individual tariffs on dozens of nations. And right now, probably the biggest one out there, at least the second biggest economy in the world, is basically saying, look, we're ready to fight.
Yep, and they're fighting in terms of currency market. Just take a look at what happened with the dollar and the offshore yuan hitting a record high, a really unbelievable move. The PBOC eased some yuan controls, signaling that confidence and the tolerance for currency depreciation. And you also had a group of state-linked funds also scooping up equities. So clearly you have the government stepping in with certain support in order to fight that fight.
Is this going to become, Alex? I mean, right now we've kind of approached this sell-off in a lot of ways as an equity market story. Of course, we've seen just as much volatility, if not more volatility, in the Treasury space. And now we're also seeing in the FX space. So what ends up driving the trade? Is it FX? Is it bonds, fixed income? Is it stocks?
Yes. That is the answer. That cross has a volatility all picking up. It's going to depend on the day. Much more coming up. We'll be speaking with Michael Faulkender, Deputy Secretary of the U.S. Treasury, as well as Carmen Reinhart. Stay with us. This is Bloomberg.
Welcome back. We continue to count you down to the close and count down to April 9th. That is the start of the next round of Trump tariffs set to kick in, barring any sort of last-minute negotiations. We did hear from the White House Press Secretary Caroline Leavitt a little bit earlier, saying that President Trump does believe China wants to make a deal, even though she did say that 104% tariffs are going to go into effect tonight. Other countries are also actively trying to make a deal, according to her. Japan getting priority in trade talks following a phone call between Trump and Japan's prime minister. All of this, of course, not settling markets as we see the Chinese say publicly that they are willing to fight. And, of course, a revaluation of the offshore yuan. And we should point out at the moment, right now, it's 7.4 and change. That's the lowest on record based on Bloomberg data. Carmen Reinhart joins us right now. She's a professor at the Harvard Kennedy School and former chief economist at the World Bank. And, Carmen, I do want to get your thoughts on how China, and for that matter, some of the other major economies around this world can, if at all, push back on what the U.S. is trying to do. I think we're having some issues with Carmen's connection. We'll try to get back to her in just 1 second. I do want to go back, Alex, of course, to the moves that we're seeing on the yuan, the offshore yuan on the terminal right now, 74092 and change. And I just want to read some comments here that came out of China a little bit earlier today. This idea here that they say they are willing to fight. These are comments coming from the Chinese premier saying that they are willing to fight, that they have the tools to do it, ample policy tools to, quote, fully offset any negative external shocks. And it raises the question that when you saw what the PBOC did, or maybe what they didn't do earlier today, letting the yuan depreciate, is this going to be the main tactic that they
Exactly.
take?
And also then you look in the Treasury market and the volatility and the liquidity issues and concerns that we've seen within the Treasury market. Does there come a point then when you have foreign governments needing to sell treasuries? We're not there yet. Jim Bianco was very adamant about that earlier, that we are not at that point yet. And you can see it in the auction today for the 3-year. The indirects were super, super strong. But is that a concern?
Yeah, absolutely. And I think we have Carmen's connection right now. Carmen Reinhart joins us right now. Thanks for joining us, Professor. Appreciate you taking the time. What is the optionality right now for China to push back on the Trump tariffs?
I think you really are talking more in the political dimension. China is too big to just simply agree as would the smaller countries. And so we are in a retaliation war, not unlike what we saw in the 1930 after the Smoot-Hawley Act. And that, I would say, led to a very significant downward spiral in trade. So I think the toughest negotiations are going to be with the big partners, with China, with the EU especially, after China.
Is there a feasible, in your view, do you think there is a feasible path to returning the trade relationships back to some sense of normalcy? I know it's going to be different just because that's what the president wants, but some sense of normalcy in terms of the relationship, the trust, and more importantly, the trade volumes.
Look, I think that any return to normalcy at this stage is long delayed, because even in a favorable scenario, in a scenario where you have a fairly cooperative attitude, I think that the damage, as long as major partners like China remain in hostile territory, is going to be very difficult for us to see any kind of normalcy in trade arrangements. It's too interconnected. And let's not forget that alongside the trade disruptions, we also are seeing significant disruptions in finance. Mm-hmm. The market may bounce back a little in some days, but the risk off that this level of uncertainty and this level of tension is creating has been also very, very negative for capital flows to the emerging world. So, at the one end you have China, and at the end you also have, and also EU, but at the other end you also have the emerging markets, which have significant problems of their own, not only because of their exposure to the trade shock, but also because of finance.
That's such an interesting point. And we're talking about finance. We're looking at the S&P now up by about 2.2%. We made a run for that lower level, that bear market, but we seem to be off that level right now. Carmen, when you take a look at capital flows, have we seen the U.S. exceptionalism capital flow narrative start to change? Or is that still intact? Because you talk to CEOs and they still see the U.S. as a good place to do business, even if their finger's on the pause button.
Look, I think more broadly, the issue of the dollar as a reserve currency, it is premature to call that bye-bye. I do think, however, it is exceptional that typically in moments of turmoil, what you see is a flight to safety, a flight to treasuries and the dollar. We have not seen that. We have seen wherever possible some diversion. And I think that with regards to your second point about investments in the U.S., I don't think that given that the rules of the game are changing in the U.S. so swiftly, so arbitrarily, it is exactly an inviting proposition right now.
So the idea that we could make iPhones in the U.S., the idea of bringing back all that manufacturing to the U.S., in your work, is that possible from a labor perspective?
Look, manufacturing accounts for 7% of U.S. employment. Manufacturing levels, the number of people employed in manufacturing, is roughly what it was just before World War II. Turning the clock back on that really will require, for lack of a better term, credible maintenance of this policy stance. Meaning, if you are a corporate, are you going to entail the big costs of reallocation if you think that the next administration will overturn Trump policies? Yeah. Trump turned over the Biden policies, and Biden had turned over the prior policies, and so on. So are you going to make long-term plans on the base and undertake significant costs on the basis of something that may not stick? So I'm dubious.
Yeah, and that's a good point. I am curious, though, Carmen, too. I know we don't necessarily know where all this is going to end, but I do want to go back to the book that you and Ken Rogoff wrote about 15, 16 years ago called This Time is Different, which is absolutely wonderful book, just economic archaeology, if you will.
Thank you, Romain.
800 plus years of studying economic cycles. Am I supposed to believe that this time might actually be different? Because there are a lot of people telling me that. There are a lot of people telling me that something had to change, this president is going to change it, and the end result doesn't necessarily have to look like Smoot-Hawley or any of the other sort of economic wars, if you will, that we've gone through through civilization.
Well, that is always the mantra in This Time is Different, right? We are exceptional. We are different than our forefathers. We don't make the same mistakes. But here we are. I think the probability of a downward spiral in trade, we actually have that graph of the 1930s. in our book. That inward implosion of trade is a very real possibility. Just take a look at what is happening among the two countries with the largest footprint in the global economy, China and the US, and the repercussions of that. So, excuse me if I remain skeptical that this will be different. In effect, compared to the Smoot-Hawley, this may add another negative to it, which is the Smoot-Hawley came after the equity market had crashed in 29. This time, this policy is what's driving the crash. So I'm not hopeful.
Well, that's a good distinction, sort of the sequencing there. Carmen, we really, truly appreciate your time. Carmen Reinhart, professor at Harvard Kennedy School and former chief economist over at the World Bank. One data point we got this morning was small business optimism falling in March by the most since 2022 on the back of intensifying tariff concerns. We are joined now by Holly Wade, executive director at the NFIB Research Center. Holly, thanks for joining us. Walk us through small business sentiment. And I know it's an obvious question, but how many tariffs are they actually worried about right now?
So small business optimism did take a step back this last month in March. It was outside of the window of the latest announcements on tariffs. So it was more in the mix of the conversation related to anticipating what tariffs may look like. It did kind of encapsulate those 2 days of tariffs that were rolled back quite quickly. So small business owners still remain in this turbulent environment of uncertainty, not quite knowing how this might impact them, to what extent it might impact them. Some have already felt it related to either the tariffs on Chinese imports or steel and aluminum, imported cars, but largely it's a bit untested waters right now. And so small business owners are a bit in a wait and see mode to see what happens and how they should proceed forward and adjust business operations accordingly.
In past economic cycles, past economic downturns, Holly, how fast do they shift typically?
Quite quickly. Small business owners, especially in light of what they just experienced during the COVID shutdowns and that turbulent time frame, they are quite familiar with looking at, their business operations, what they need to do to survive and keep those doors open. And so because they have emerged from that time frame into now, I anticipate their reaction to either, impacts that might affect them as quite quick. So in the next few months, we'll see to the extent to which the policy shifts will impact them and see how they're moving forward and adjusting operations, whether that's related to employment, prices, scaling back or scaling up, depending on their industry. And it will take some time, though.
Holly, how does this compare to 2020 during the pandemic, when there was also a supply chain issue and also potentially an employment issue as well and a demand issue? How has that set us up for understanding small businesses right now?
Certainly. So right now, when we look at our responses from March, the employment situation is still holding strong. So while they've scaled back on plans to hire, again, that, kind of wait and see mentality of where things go before they start really investing in their business. But the unfilled job openings levels are still very, very high, especially in those industries related to construction, manufacturing, and transportation. So that still is largely intact. When it comes to supply chain disruptions, we haven't seen much movement there. We have a question related to supply chain disruptions. In 2022, we saw that, and before we saw that, huge volatility there, but we haven't recently. That's remained pretty stable. We'll continue to see how that starts to fluctuate as some of these tariffs become kind of more known, how they're going to impact them. But we haven't seen much movement in that capacity. And then on the sales front, we saw a huge spike right after the election on anticipating increased sales. They were very enthusiastic about what that might mean for consumer spending. And that has ebbed back quite a bit from that high level that we saw in December of the net percent of owners expecting higher sales.
Yeah.
And it has come down quite significantly. That was one of the main reasons for the drop in optimism this last month.
Yeah, Holly, this is a very sobering report, and it'll be interesting to see what the next one looks like. Holly Wade, Executive Director of the NFIB Research Center, gauging the pulse here of what's going on in the world of small business. Meanwhile, gauging the pulse of what's going on inside U.S. financial markets, and, well, that pulse is not doing well, Alex. Still bear market territory for the S&P 500.
Yep. If we close between 49.15, a spot 32, which we are below that level right now, that would indicate a bear market from those highs in February. And nothing seems to be spared, whether you're looking at the cyclical stocks like materials, energy, et cetera, or you're looking at small caps or technology. All getting hurt right now.
Yeah, and of course, it's a lot of those really economically sensitive sectors that are really taking on the chin. Of course, big tech also getting hit hard as well. Apple, really kind of the poster child, I think, for everything that's going on with tariffs. Obviously, outsized Chinese exposure on both the supply side and even on the customer side here. Down 6% on the day. And remember, this was a stock that at one point looked like it was on its way to rallying 6% here on the day. So a huge turnaround for one of the largest companies in the world.
Yeah, remember when the VIX was at like 38 and now it's at 57? And that was just a few hours ago?
I remember when it was at 16. I remember that was like.
No, I don't remember. What was that?
I know.
That was wasn't it 13 at some point? I mean, really.
Volatility reigns. And in all seriousness, we should point out, too, volatility in the equity market right now, about 50% of where it would normally be over the last 20 days when you average that out. But then you look in the Treasury space, take the TLT as a barometer for that, about 90% higher than where we've normally averaged in terms of volume on the TLT.
Yep. And speaking of that volatility, we are now off of those lows of the session. I mean, this action is so whippy right as we head into the close.
Anthony Saglimbene joins us right now, Chief Market Strategist over at Ameriprise Financial, helping us count you down to the closing bells. Those bells now just about 9 minutes away. Anthony, first of all, great to see you in person. Yeah. I wish you were here on a better day. But you're actually a great person to talk to because the types of moves, intraday moves that we've seen, particularly today and yesterday, I won't say unprecedented, but kind of a once-in-a-cycle type of moves that we see. Do you see any reprieve to that? Or is this all now just about waiting for some sort of clarity on the trade front, on whatever deals might potentially get made?
Yeah. What you're seeing in the overall market right now is typical bear market activity, right? There's been a loss of confidence in the economic outlook. There's now a deteriorating confidence on what the profit outlook is going to be. We're going to be moving into earnings season pretty soon. And what had started in small caps, your previous guest was talking about the momentum and sentiment shift, has now migrated into the NASDAQ. And we'll see where we end today. But now it's starting to shift into the broader measures of the market. And that loss of confidence generally precedes, especially when we're in a bear market, generally precedes recessions. And that's why you're seeing so much volatility in the market right now, because it's very difficult to figure out what the economic and profit outlook looks like after these tariffs start getting imposed.
When we look to folks who maybe could sort of calm the market, whether that's the president, whether that's people in the and Wall Street itself, or the corporations. I mean, you mentioned earnings season. It actually starts tomorrow with Delta, and we get the big banks on Friday. I mean, what can they say, or what do you want to hear those CEOs and CFOs say about, I guess, their view on things, and more importantly, whether they think they can hold the line in the interim?
Yeah. Typically, when we see this type of volatility, you generally need a policy response, either a fiscal or a monetary policy response. Obviously, it's the fiscal policy that's creating all the volatility. And we just heard from Chair Powell on Friday, I don't think the monetary policy or the Fed is going to move very quickly. So it does come down to what corporate America has to say about the earnings that we got in the previous quarter and then their outlook. The earnings that we're likely to get for the first quarter should be solid. However, that's backwards looking. It's really about the guidance. And I think what we're going to see is company by company, industry by industry, what do they see for demand? What are they seeing for consumers and businesses? And what is the effect on profits and margins? And all of that seems pretty negative right now.
And you know what? They're not going to know. There's no way they're going to know if no one else knows. In terms of the selling that we're seeing in the volatility, is this all orderly, or are you seeing signs of disorderly selling?
It is orderly. So as I mentioned, we've seen small caps in technology, the riskier parts of the market sell off first. Now we're seeing broader areas of the market. We saw some capitulation on Friday in things like healthcare and consumer staples, which were holding up well. We're seeing a little bit more trading activity, obviously, with the volumes today. So I think it's orderly. What we've been advising our advisors and clients to do is maintain diversification. Bonds are working pretty well in this environment. Alternative strategies, large cap value, some of the defensive areas of the markets. That's how you can mitigate some of this volatility. Even income producing strategies can help mitigate it. It's just very difficult when there's broad sell-offs like we're seeing right now to kind of keep that diversified kind of approach.
But on the income strategies, though, do you think companies are going to have enough to actually hold onto, whether it's dividends or the buyback programs? They're going to be confident enough?
Yeah, I think it's important to remember companies' balance sheets are very strong. I think we're going to get a good look in financials on Friday, and I think what they're going to say is consumers and businesses are concerned, but their balance sheets are strong. Loan activity, has been okay. And so I think we're going to get a little confirmation that at least from a fundamental standpoint, things are on solid ground. However, as we see these tariffs get enacted, as you see more concern about the growth and profit environment, that's where you could see more volatility. But the income statements of a lot of the S&P 500 companies are very sound, particularly technology, which has gotten hurt really bad.
Yeah, yesterday Broadcom announced a buyback, right? Take a look at the markets, man. We are at 49.66. I'm just saying this was like a really whippy turnaround. We're clearly seeing buying into the close, albeit we are off the lows of the session and we're still down for the day, but nonetheless, that buying into the close. Okay, so what do you do for safety?
Yeah.
Do you want to sit somewhere? Back end of the Treasury market, that's not safe right now. That's pretty whippy too. Where do you go?
You can be kind of intermediate term in terms of bonds, high quality. So that means high quality corporates, high quality governments. Within stocks, I think it makes sense to kind of be a little bit more value orientated, focus on high quality companies that have stable streams of earnings and stable cash flows. Even in an environment, if we do see growth slower, we enter a recession, some of the stability in companies on the large value side should hold up a little bit better. And just lastly, this is the time to start putting your shopping list together. There's a lot of really high quality technology companies that are down 20, 30, 40%. If you believe in the AI story and you believe in the secular theme, at some point, these companies are going to look attractive.
And that's a fantastic point. You're 100% right. I do have to ask you, though, about a certain segment of our population that doesn't necessarily have that time horizon. So basically retirees or people near retirement. For us younger folks, relatively younger folks, we can look at these stocks and say, okay, that's a bargain. We know at some point Apple probably will be back up to where it was. But what do you say to those older folks who are looking at their portfolios, their retirement accounts, and seeing the destruction that's occurred over the last few weeks?
That's a great point. And so what we've kind of advised our advisors and clients to do is kind of think about it in a bucketing approach where you have a part of your nest egg in cash that can do the expenses. The other part should be growth orientated. And typically when we see volatility this high, the returns for equities over the next 1, 3, and 5 years tend to be above average.
Anthony, thank you. Anthony Saglimbene, Chief Market Strategist at Ameriprise Financial. Let's go down to Washington, D.C., where the president is speaking.
It's every week. Germany went green, very green. They went so green they almost went out of business. Germany was finished. They went to wind. The wind wasn't blowing too much. And they went to all sorts of other things. The Green New Scam hit Germany, too. And guess what? Now they're back to coal. They're opening up coal plants all over Germany. We're the ones that aren't doing it. I call it beautiful, clean coal. I told my people never use the word coal unless you put beautiful, clean before it. Right, Doc? So we call it beautiful, clean coal. Beautiful, clean coal. So today, thank you. Today, we're taking historic action to help American workers, miners, families, and consumers. We're ending Joe Biden's war on beautiful, clean coal once and for all. And it wasn't just Biden, it was Obama, and there were others. But we're doing the exact opposite. And all those plants that have been closed are going to be opened. If they're modern enough, or they'll be ripped down and brand new ones will be built. We're going to put the miners back to work, and I said I was going to do this, and I've said it loud and clear, and it's time to do it, and we need it. And I look at these people behind me. I don't want to have any arm wrestling contests with any of them, but they've had a little more practice with the lifting things, I will say. But they are great people, and I know them indirectly for a long. That includes you guys for a long time. And they're great people and with great families and come from areas of the country that we love and we really respect. And I want to thank Secretary Doug Burgum for doing such an incredible job. From the day I met him, I knew I wanted to have him in my cabinet. He took a shot at running, and he was so good and so solid that he made no news. And that was good. But I saw him, and I saw his beautiful wife, Catherine, and I said that they're going to be a team. They are a great team, and they're going to be working for this country someday. And one of the first people I called after I won. So thank you very much. And along with the Energy Secretary, Chris Wright, and I was going to make Doug, actually, the Energy Secretary. And he said, sir, you have one person who's much better than me at this, Chris Wright. I said, who the hell is Chris Wright? I have no idea who he is. And then I learned that he's the most respected person in the energy business by far, far and away. For Doug to say that Doug's got a big ego was very tough.
President of the United States.
Catherine was there, right?
Speaking
Catherine
at the White House right now. President of the United States speaking at the White House, announcing new policy when it comes to coal. We are going to check back in with the president and bring you his comments as we get them. You can type in live, go in your Bloomberg terminal to continue following. But we do just want to get a quick check on the markets, which did just close just a couple of minutes ago. An incredible day once again, where we saw the S&P gap up by the most in quite some time. And then that trade faded in a big way. An S&P 500 that was higher by about 4% on the day, closing out the day down by about 1.6%. Romaine Bostick here alongside Alex Steele. Scarlet Fu joins us as she does every day at this time. A NASDAQ composite down 2% on the day, guys. The Dow Jones Industrial Average down 0.8%. And the Russell 2000 closing out the day lower by 49 points or 2.7%.
It should be known that the S&P briefly traded into a bear market, trading below the level of 49.15, bounced off of that level pretty significantly, but still closing at the lowest level since April of 2024.
And really, the turning point came when the White House, an official, made clear that the U.S. is going to proceed with these 104% tariffs on Chinese goods. Given that it's supposed to start at midnight tonight, there's precious little time for anything to happen before then. And
of course, it didn't help matters that you had the Chinese premier basically saying that China has the tools to fight. It also didn't help matters that the PBOC seemed to be perfectly comfortable letting the yuan depreciate to a record low.
Yeah, pretty tremendous. Also taking a look at the bond market, guys, we cannot forget that because there was some serious selling there on the back end. We had an auction for the 3-year that went pretty terribly. And over the last 2 days, you saw the 30-year yield rise 33 basis points. We haven't seen that move since January of 2022. These are very big moves in the long end of the bond market.
And I just also want to talk about some of the big moves in the equity market here on this day. I mean, Apple was really indicative, I think, of the volatility that we saw. A stock that had rallied 5% to start the day. And then Scarlett had dropped down 6% or so right before closing out the day, just down by about 5% here. But it's that volatility that I think that investors, if you are still invested in this market, you're going to have to stomach probably for a little while longer.
Yeah, and Apple, of course, its most important and best-selling product is the iPhone, which is made in China. So that all comes back down to whether we get a deal on Chinese tariffs or not. And right now, that's not looking like it's going to happen. When you look at the S&P 500 and the 11 industry groups, everything is down, although it should be noted that on a 24-group basis, you did have some rotation into some more defensive sectors. Healthcare equipment and services, for instance, gaining 0.6%. The insurance companies also gaining about 0.25%, mainly health insurers.
I also thought it was interesting to see some of the financial companies like brokers, CME, Schwab also getting a nice bid. There was an interesting note out a little bit earlier today from the sell side saying that if you are looking for a defensive play, healthcare stocks, insurance stocks, like you were just talking about, Scarlett, is one place. There are also recommending some of the financial brokers.
You know who you would not recommend right now are the cyclical indices. Look at the materials, look at energy, oil really rolling over. It was a pretty powerful sell-off with a 50 handle when it comes to WTI on intense trade rhetoric and that 104% tariff from China. Taking a look at materials, lowest level since October of 2023 within the S&P. Energy, May 2023. Really ugly for those indices.
Alex, we're going to say goodbye to you so you can get some rest so we can do this all over again tomorrow.
Looking forward to it.
Scarlet Fu sticks with us, of course, as our coverage continues for the next hour. A full breakdown of all of today's market action and, more importantly, a push ahead to tomorrow. Remember, those tariffs do start to take effect at midnight tonight. And the big question is, will there be a deal before we get to it? Recession risk being priced into this market. A JP Morgan model right now showing that the Russell 2000 pricing in about an 80% chance of recession risk. Jess Menton joins us right now, who leads our equities coverage here at Bloomberg. Jess, I'm not sure where to start. We came into today, and it looked like people had found some optimism. They were buying the dip. Jim Bianco started off our show an hour ago, but he said, look, that was kind of a head fake. You know, it was a little bit of a short squeeze. And once a lot of those folks saw that nobody else was joining the party, that's when you saw the big drop down.
And everyone was talking about how oversold those conditions were if you were looking at the 14-day relative strength index being at the lowest it's been since the height of COVID in 2020. So there were a lot of arguments when you were looking at different pockets of technicals. But what I've been focusing on, and I ran a piece about this earlier around the opening bell, was just because of the amount of short interest, especially yesterday. Yeah. It was the highest since December. So that was right after the Federal Reserve had signaled at the end of last year that it was going to pause those interest rate cuts. And so really what you saw there, a lot of that short covering, but then also people who may have had those positions on, who once you have stocks rallying have to unwind those bearish bets and then unravel is what we saw here.
Was this orderly to you, what we saw today? Because I keep hearing that word thrown around.
No, I don't think this is necessarily orderly, because there's a lot of traders who like to throw that around as well. But even yesterday as well as today, when I've been talking to traders who work on Stifel's desk as well, they were talking about when you see big swings like this, they're seeing a lot of their clients rotate out of more of the riskier types of stocks, piling in more of the dividend paying type players. So even when you're seeing rallies like this, it's not rallies back into those riskiest corners of the market, and especially the Russell 2000 and other pockets like that. You saw those fall even more so than the broader market today.
Yeah, the rotation away from the growthy stocks that we've seen in the past certainly has stayed intact. One thing, though, that we should point out with today being Turnaround Tuesday is that the market was primed for a rebound today. We saw it in yesterday's trading.
We even saw at the open, the S&P 500 rose as much as 4%, basically erased all of those gains and more some since it ended up finishing lower today. So we're still seeing those whipsaw moves, even with the VIX coming down below where it had spiked around intraday on Monday around 60. You're still seeing it about over 130% above its average over the past year, and as well as over 130% above its 50-day moving average. So even though a lot of people want to talk about once you see the VIX fall below certain thresholds, there people start to buy in. You're still seeing things very elevated right now.
When you saw that gap up at the open, though, what was your first thought? Because typically when you see a gap up at that side, and by my metrics, and your team could probably crunch these numbers better, this was the widest gap up that we've seen. It might be on record, at least on a points basis.
Well, actually,
and I know that gets skewed because of the growth in the markets, but it's still significant.
And we also have a metric where you can see the intraday swings. So even bottom to top yesterday, intraday, it was 8.5% when you saw it from where we were at the lows to the highs as well. And so you saw it not quite as dramatic today, but pretty close here. So that's really more indicative of something that isn't necessarily conviction in the market as well. And especially technicals coming into play, because if you look at this year's low, 48.35 was the intraday low earlier this week. That's going to be a key figure tomorrow as far as where the S&P 500 is trading.
Worth noting that the S&P 500 closing below 5,000 for the first time since April of 2024. In terms of actual levels for the S&P 500, have we seen that change a lot among the strategists? Where's the median?
Right. So the median, actually, it's interesting because the way we compile it through the most recent estimates in the Bloomberg terminal, the median was over 6,000, but you've had over the weekend. So obviously Julian Emanuel, he's been on Bloomberg television a few times, but over the weekend, he actually cut his target as well. But what's interesting to me, because you've had Ed Yardeni cut his target twice. You've had David Costin over at Goldman Sachs also cut his target twice in a matter of just weeks. And then Savita Subramanian also cut her target from 6,600 6,600 down below 6,000 as well. But what's interesting about that is when you see this, it still signals pretty hefty gains here, as well as Oppenheimer. So that still signals potential double-digit gains for the S&P 500 at year-end. So even though you've seen a number of strategists cut their targets, it's still implying strong moves here by year-end. And I think a lot of them are really trying to figure out how to model a lot of this. I was even talking to...
But what are those strong moves based on? Earnings?
So I was talking to...
tax cuts.
Right. Well, that's the thing. But Scott Kroner at Citi, when I was talking to him, he was saying, it's impossible to model for something like this. Ed Yardeni said the same thing as well. So then I asked, why are you even... Why bother cutting if it's still an elevated target?
I'll share with you. Someone, I asked this question who basically said he was not going to actually do a target. And he said, I said, why not? He said, because I don't want to get sued.
Yeah. Well, my question was, why not put it into the modeling when you knew that Trump said he was going to be aggressive from the get-go?
Yeah.
All right, Jess, Menton, fantastic stuff. Really great context here for the late declines that we've seen in equities. Coming up, a broad-based discussion with Scott Bessent's right-hand man. We're going to get a chance to sit down with Michael Faulkender. He is Deputy Secretary of the U.S. Treasury. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another wild day on Wall Street. A lot of investors thought today would be a reprieve from some of that volatility. They were wrong in a big way. You don't see the S&P 500 on that board, but you should, because it actually opened higher by about 2.5% on a points basis. It was the biggest gap up on the S&P 500 on record. Of course, that's measured from yesterday's closing price to today's opening price. But that rally, which at one point reached 4%, faded by midday. At one point, the S&P was down by about 3%, closing out the day down 1.6. The VIX, which actually did get a bit of a reprieve, at one point dipping all the way back down to 36, closing out the day back above 50 there. And you see the volatility in the Treasury space. A 10-year yield now at 4.28, a yield that Jim Bianco said at the top of the program, quite frankly, probably needs to be deep in the threes. We should also point out that when it comes to volatility in the equity markets, at least about 50% higher than what it would normally be. But volatility in the Treasury space, more than double.
Yeah, pretty incredible stuff, especially in the Treasury market with a lot of auctions this week. Let's take a look at some of the day's big movers on an individual basis. We're going to start with Broadcom, up 1% after the chipmaker approved a new $10 billion stock buyback program. Now, typically, this is not a move worth noting, but given the sell-off that we've seen in the market today, it was a sign of confidence, according to some analysts, that sends a fairly positive message to investors, although Broadcom did give up a big chunk of its advance. And Albemarle, you could see down 13%. This is the chemical company. It's gained only once in the last 10 trading days, now at its lowest since April of 2020, getting slammed for its China exposure. The company gets more than 30% of its revenue from Asia. Which brings us to our top story this hour. Turnaround Tuesday really failed to last when the White House made clear that it is proceeding with 104% tariffs on Chinese goods. It's yet another sign of stress across financial markets. Still, when we spoke with Lisa Shallett of Morgan Stanley earlier, she points out that as much volatility as that you've seen in things like the credit market, that has been offset by the downward move in rates. So for companies, that means the overall cost of capital for the most highly rated companies, the most high quality companies, has remained relatively stable. And that is, for now at least, remain constructive for investors and constructive for the U.S. economy.
Well, you hope so. Here, you are seeing a little bit of move, of course, in some of the CDX indices on the Bloomberg terminal. And of course, the volatility raising a lot of questions here as to what can tamp this down. Anthony Saglimbene, right here on this program, just a little while ago said, it's going to be policy. That's what will calm this market down. So let's get a view on that policy and get right now down to the White House. Joining us right now is Michael Faulkender. He's the Deputy Secretary of the U.S. Treasury with just a few more hours to go. And before we get to midnight, I am curious, Michael, if we are, or people out there should expect any type of negotiated deal before that deadline.
It's great to be with you. As the president has said, the U.S. is looking to discuss some of the tariff and non-tariff barriers that other countries have put in place. You saw a stark example with the Chinese raising tariffs on us, and so there's been a reciprocal move by the United States on the Chinese imports, whereas with the Japanese, president said today that the Treasury Secretary and the U.S. Trade Representative are going to lead his negotiations on this behalf. So there is work to be done. We want to make sure that the United States manufacturers continue to receive a fair environment when they export their products abroad. And so what we're looking to do is have countries that are willing to negotiate with us on their tariffs and non-tariff barriers work with us to remove those barriers.
So, I mean, what exactly, though, can those nations, not just China, but the other ones as well, Europe and the other nations out there, actually offer? Because there's been a lot of reports out there that Vietnam offered to drop to 0%, and that was rejected. Europe offered to drop its tariffs to 0%, and that was rejected. What did they have to put on the table that would satisfy your boss?
Right. So again, it's not just the tariffs per se that are the problem. It's also the non-tariff barriers. So when countries are engaging in subsidies, whether they're engaging in intellectual property theft, whether they're engaging in slave labor activities, all of those things are also going to need to be on the table. In addition to that, the president recognizes that for decades, the U.S. has entered into relationships that have caused the export of American industrial base, that have caused the outsourcing of manufacturing jobs. And the president believes that we must have a strong industrial base here in the United States in order to achieve not just our economic goals, but also to achieve our national security goals. And so it's going to be a combination of working with us on the tariffs and the non-tariff barriers, but also making sure that there's investment back in the United States that facilitates the manufacturing base that we need to defend ourselves.
Investment back in the United States. What kind of timeline is the White House thinking of when it comes to bringing back some of those manufacturing jobs?
Right. So what we're looking to do is to make strides and commitments on the part of foreign governments to recommit to working with the United States to see those activities take place. In some instances, there are factories that are idle that we would like to see working on in order to bring some of that existing capacity online. Where factories are partially operating, perhaps we can see an increase in the capacity utilization of those factories. And then obviously we're looking to see commitments to the construction and upgrading facilities as part of our discussions with them as to how we can make sure that the U.S. has an appropriate industrial base here in the United States.
You mentioned that, of course, you're concerned that it's not just tariffs, it's other behavior as well. We look at what China's doing. It let its offshore yuan fall to the lowest level ever, weaken. Are you concerned that China is responding to these tariffs by devaluing the currency? And if that is the case, how does the U.S. respond to that?
So we have seen the behavior of the Chinese for decades, right? It's not just their willingness to manipulate their currency and intervene in currency markets. It's also the intellectual property theft. It's the forced technology transfer. It is the use of slave labor in some of their provinces in order to support their activities. It is the subsidies that they provide. All of those activities have led to a massive advantage to Chinese manufacturers that have caused the decimation of local towns and communities from the loss of manufacturing base in those areas. And of course, unless the Chinese are willing to work with us and negotiate on those things, then we're going to continue to see this tit for tat between ourselves and the Chinese. We would much rather see them remove the tariffs that they the added tariffs that they added yesterday. We would like to see them work with us to address what you just talked about, which is the ongoing currency manipulation and, of course, the technology theft. Secretary Mnuchin and Ambassador Lighthizer in the first Trump administration tried to address these issues with the Chinese. We sought to have those implemented through the Phase 1 China trade agreement. They have not fulfilled their obligations under that, and instead they have doubled down on a policy that just exacerbates those tensions. And so what we would like to see is for them to live up to their commitments that they made the first time and see them make tangible strides to operating in an equitable way with the United States.
I have to ask you, Michael, a little bit about the market moves. And I know the president has made it clear he's kind of playing a long game and he's not as concerned about some of the short-term moves. But as Deputy Treasury Secretary, you have to be concerned. It's part of your job to ensure that there is some sort of semblance of financial market liquidity and, more importantly, some sort of financial market order. Have there been any sort of discussions or mitigation talks taking place to ensure that we still have an orderly and functioning market should this turmoil continue?
Right. So anytime we have volatility in financial markets, Treasury is going to make sure that we watch various early warning signals of any turmoil there may be. As you said, we're primarily concerned with ensuring that price discovery occurs, that there's sufficient liquidity in markets, and we are continually updated on market conditions. So far, we have seen that markets have been able to completely handle the volatility that we have had. We have not had any liquidity concerns, but obviously Treasury is going to continue to ensure that markets continue to function.
Is there any sense here, Michael, that some of the turmoil we've seen in the market could potentially be systemic? We've been here before, and we know how quickly that risk can sort of pop up.
Yeah, so we're not seeing any systemic risk concerns. Markets continue to function well. Liquidity is there. I think that the market should just take the longer view, as the president said, as to the key importance of reprivatizing our economy, reindustrializing our economy, the enormous benefits to economic growth and competitiveness that are going to come from redomesticating a lot of this activity. And I think that once you see countries come in and discuss how they can make a fairer international trading environment, that you'll see markets recognize that conditions are going to be better after we engage in these discussions and after we see other countries put in place a fairer trading environment for American companies.
To Romain's point about the volatility we're seeing in the markets, we're hearing from folks in the market that U.S. Treasuries and the U.S. dollar may no longer be the risk-free instruments that they once were because of the unpredictable rollout of tariffs. How do you respond to concerns that the White House's policies could undermine foreign demand for U.S. Treasuries?
Yeah, as the Treasury Secretary has said, the dollar is and always shall be the world's reserve currency. We are going to continue to make sure that we have the most liquid capital markets, that we engage in our fiscal stewardship in a responsible way. It's part of why the president talks about making sure that we continue to have a strong economy that continues to support economic growth, that continues to support the belief on the part of markets that the U.S. is going to continue to be the best place in the world to invest. And so we don't see there being any concerns about retaining our status as the world's reserve currency and thereby retaining the demand for dollars and dollar-denominated assets that facilitate the international trading system.
Michael, you worked with Steve Mnuchin, the former Treasury Secretary under President Trump. You ran the Paycheck Protection Program, the lending program to help small businesses during COVID back in 2020. We saw from the NFIB that small businesses are seeing a deterioration in confidence. Could there be a similar type of plan again to help them weather the storm? Is there discussion on that right now?
What there's discussion about is making sure that the full implementation of the president's agenda. I know that there is a lot of focus solely on the tariffs, but if you look at our commitment to extending pro-growth tax reform and also adding in additional elements into that, things like no tax on Social Security, no tax on tips, extending bonus depreciation, perhaps some assistance on investments in factories here in the United States, couple that with a deregulatory agenda, an American energy dominance agenda, making sure that we're reducing spending in order to get our fiscal house in order. Full implementation of the president's policies are going to be overwhelmingly beneficial, not just to the American economy, but to American small businesses.
When do we get to the good part, Michael? I know there's been a lot of folks, at least in Wall Street, they're really, when the president came in to office, or at least when he was elected back in November, everyone was really focused on the tax cuts, the deregulation, the things that most people saw as being not only friendly to businesses, but more importantly, friendly to the economy. When do we see that?
Yep. Yeah, I think that a lot of people lost sight of the fact that the Senate passed the budget resolution last Friday that facilitates us engaging in these reconciliation negotiations. So the House and the Senate are very close together when it comes to getting in place the budget resolution process that unlocks reconciliation, that allows us to get that tax reform done. We continue to look at June, July as a time frame to have a bill on the president's desk. There is ongoing, continuous efforts for us to unleash capital by taking another look at the regulatory stranglehold that the Biden administration and the Gary Gensler SEC put on U.S. capital markets. The Treasury Secretary is leading efforts through the FSOC to see that capital is available for businesses of all sizes. There's a constant deregulatory agenda coming from all departments and agencies of the administration to reduce the cost of doing business and to make sure that compliance is smart but not overly burdensome. And of course, putting together that reconciliation package is going to bring down the excessive spending that potentially is crowding out the ability of businesses to gain access to money. So we're simultaneously doing all of those things. I realize that there's a lot of focus on the trade agenda right now, but we continue to make progress on all of those others. And as the negotiations are ongoing, again, with the Secretary leading the way on discussions with the Japanese, I think all of those are going to lead us towards a lot of calming of markets, as you see, a willingness of our friends and allies around the world to address these longstanding trade issues.
All right, Michael Faulkender, Deputy Secretary of the U.S. Treasury, joining us from the White House lawn. Thank you so much.
And we should point out, while he was speaking, we did see yields here in the United States continue to move higher, and we also saw that offshore yuan continue to weaken now at fresh record lows there. We're also getting some earnings crossing the wire. This on Cal-Maine Foods. This is the biggest publicly traded egg producer. Net sales in its most recent quarter beat by a mile, $1.42 billion, up from about $703 million in the previous year. So basically a doubling in revenue. Dozens of eggs sold right now, up about 10% year over year, though the company says those numbers will come down, of course, and they expect to be at least in the mid-single digit accretive to Cal-Maine Foods earnings starting for its fiscal 2026 year here. We'll keep an eye on that. You see the shares moving lower, but there is a big focus on those tariffs and how it affects the agriculture industry. It's threatening a lot of pockets of that industry, including dairy, which exported $8.2 billion of products last year. That's more than half of those exports, of course, are shipped to Mexico, to Canada, and where else? China. We want to get a view from the ground, from a real farmer. His name's John Boyd Jr. He's the founder and president of the National Black Farmers Association, and he manages a 2,000-acre farm in Virginia, cultivating soybeans, corn, wheat, hemp, and produce. Mr. Boyd, thanks for being here today. When we talk about the impact of these tariffs, you're sort of dealing with two sides of it. Obviously, the potential products that you have to maybe import in, whether it's machinery or fertilizer, things like that. And of course, some of the finished products that I'm sure you would want to export. What is your viewpoint right now as to your ability to do both of those things?
Well, the president's tariffs certainly have put a damper on all the things that you just mentioned. And these are very troubling times for America's farmers, where we should be putting our planters in the field right now. We don't have farm operating loans in place. The banks are running from us because of these poor, dismal markets on corn, wheat, and soybeans. Soybeans hovering around $9 a bushel, and wheat somewhere around $5 and $4 corn. No lender wants to extend credit to America's farmers looking at these dismal markets. And every day the president mentions the word tariff, it gets even worse for us. The Department of Agriculture is laying off workers and closing up offices that farmers rely on in local areas and communities to do business. So as I listen to this, my message to the administration is, this isn't fun and games and some bargaining tool for America's farmers. You're talking about rich, long history and legacy. I'm a fourth-generation farmer. I've been taught the art and skill set of farming by my daddy and grandfather. And our farm is up for grabs here based on what the president has put in place. So they said that they're going to offer some sort of financial assistance to farmers that we don't have. The prices of equipment is rising, so farmers aren't buying this equipment. John Deere and other Case International, they're going to feel the pinch. And at the end of the day, the American consumer is going to feel the pinch. Folks are ringing off the hook from farmers who say, hey, Boyd, should I plant my crop this year or should I sit this out? All of these things are really troubling for us.
John, you lay things out really clearly for us. So how do you plan? How do you forecast? How do you make plans going forward for 3 months out or 6 months out? How much visibility do you actually have?
Well, right now, I should be in the fields, but I'm actually having to meet with seed dealers to see what could be worked out to get my crop in the ground. And my message for bankers who are out there, make sure that you extend credit to America's farmers and come up with a less troublesome way for us to borrow money out here. And these companies, they should give back to farmers right now at this trying time. Reach out and support us. I mean, this is the time to do it, not after planting season when it's too late to plant. And one of the things that is really troubling is that the president wanted to put in plan a policy to help South African farmers, bring them to the United States and give them a fast path to citizenship, but he won't help us right here at home, get our land out of inventory. These are things that farmers need, right now.
So I am curious, though, John, when we talk about the potential help, and the administration has said maybe there could be some help in terms of whether it's subsidies or other sort of breaks to give farmers as the administration works through what it says is a long game. I am curious, though, but in terms of negotiating with your suppliers and for that matter, even your end customers, are you seeing any sort of wiggle room there? Is there any hope that you might get a reprieve on that end?
So far, none of the companies have reached back to offer us help. Here at the NBFA, we have 150,000 members, and not one of these seed companies have offered to give back. None of the equipment companies have offered to give back, and they're running scared of this president. And, the president is making these decisions, and the Ag Secretary, without farmers at the table, which is very troubling for me. When we find out things, we're hearing about it on Bloomberg News. China is the number one purchaser of U.S. grown soybeans, whether we like it or not. We need to repair relations there. Corn, Mexico is the number one purchaser of U.S. grown corn. We need to make the repairs in the relationship there. Canada, potash, all these things that we need for our farm. Those are the three biggest, should be adversaries for America, and we're making all these people our enemies. It's not smart policy, and it's not smart diplomacy on, as we see it as farmers out here.
John Boyd Jr. is founder and president of the National Black Farmers Association, sharing his view from the ground. Thank you very much. Well, tensions between the two largest economies in the world clearly escalating as China vows to, quote, fight to the end against Trump's tariffs. The risk of a prolonged trade war is certainly weighing on ports. And as we know, China is the single biggest trading partner, at least to the port of Long Beach. It accounts for 62% of imports and 21% of exports. Joining us now with more is Mario Cordero, the CEO of the Port of Long Beach. Mario, what does volume look like right now? And I'm curious to get a sense of how you expect that to change and at what point.
Well, thank you, Scarlett. Well, first of all, the volumes look very good right now for Long Beach. We've had some historic months and, in fact, a historic year, 2024. 2024, we had 9.6 million, and that's a historic number for the Port of Long Beach. And we started off the year with a January number that put us at the number one port in the country with regard to moving TEUs or containers here, at least for January and certainly for the fiscal year. But in either regard, the question is, what does it look like for the second half of the calendar year 2025? And that is a serious concern for us.
It's a serious concern for you, and I guess I wonder how much you can project it might look like given what we've seen in the past. In 2018, the last time President Trump imposed tariffs. Is that a good analog in any way for you?
Well, it's good to look it into context here. So when you go back to 2019 and the first year of studying the implementation of the tariffs back then, the question then was China plus one, as you may recall. In other words, there was a focus on China. So the good news for the Port of Long, well, the bad news for the Port of Long Beach, we lost 20.5% of cargo volume with China back in 2019, but we gained 10% in other regions, primarily double-digit growth in Vietnam. Now, what's different is every country is being now hit with these tariffs. So now it's across the board. So again, for the second half of the year, I will tell you that we've done an in-house look to try to forecast a little bit what that might look like. Worst scenarios, it will be a 20% reduction for second half volume in 2025 for the Port of Long Beach. And it could be at least, 10, but, we have concerns about how that's going to impact imports overall from Asia.
And it's not just the tariffs that are affecting that as well, Mario. There's concerns here about economic conditions. And unlike what we saw in the pandemic, people were still flush with cash, largely because of fiscal policies that put that cash in their pocket. This time around, it's going to be a little bit different unless, Congress does something dramatic over the next few weeks here. So I do wonder whether, as you adjust for whatever may happen going forward, whether you also have to take into account domestic economic conditions.
Absolutely. We closed out the year 2024 Again, it's been a vibrant economy that we've had here in the United States, robust consumer spending. And the bottom line is consumer spending accounts to about 68% of our GDP. So if the consumers are going to be price sensitive and now start reducing their purchases, then it is going to impact the economy. It's certainly going to impact in terms of what we're going to see for the second half of the year. So again, a prolonged uncertainty with regard to the tariff question is of concern, because that's going to be the long-term effect if, in fact, again, we don't have, number one, clarity and certainty, and certainly relooking in terms of what we do with our allies with regard to some of this retroactive or retaliatory tariff questions that have popped up here, which, again, another issue that's different from what it was back in 2019.
I am curious, though, have you had an opportunity at all to actually talk to this administration? I mean, are they listening to you, or do you have a voice in Washington right now?
Well, I could tell you that, the Association of American Port Authorities, we had our annual conference there, or excuse me, our legislative summit there just about a few weeks ago. We did take the opportunity as AAPA and some of our executive directors here of major ports in the country to have those conversations with certain agencies and administrative representatives. So I will tell you is that, again, I think that I was confident that there's a pragmatic thinking that perhaps what we need to do for the country. But again, let's step aside and wait and see how this plays out. So hopefully, again, you're already seeing that because of the uncertainty and what we're seeing in terms of the volatility of the markets in the past week, in a couple of days, last week for 2 or 3 days, we saw approximately $6 trillion in wealth being dissipated. So again, we're now seeing what the immediate effects are of these tariff discussions or implementation. So let's see and step back and see how this plays out.
As you step back and wait to see how this plays out, I wonder if you're in communication with other ports in the United States and perhaps even other ports outside of the United States and kind of thinking ahead and planning ahead for how to best position yourself.
Yes, I think the bottom line with regard to those conversations, we all believe that we are certainly in an uncertain time. So it's hard to really forecast what we don't know what's going to happen in the future in terms of where this tariff conversation is going to go ultimately, particularly with our allies, be it Europe, be in Southeast Asia, like countries like Vietnam, in terms of what that alternative was back in 2019, and of course, Latin America and Canada, specifically Mexico and Canada.
Once you do get some more clarity, some more certainty, what is the one thing, the first thing you're going to do that you kind of have to hold off on at this moment?
Well, I think history tells you that when we have clarity, I think the ports of America will adjust. And again, at the end of the day, ports are going to be very important to the trade discussions of any country, not just the United States. So I think, again, there's a divide right now in terms of what free trade is as we define it going forward. But once this plays out, I think once we have certainty, again, history will tell you that the ports will survive and we will adjust to whatever administration's policies that go forward. But again, what we need today, not only the ports, but the business sector and Wall Street, we need clarity and we need certainty.
I am curious about the health of the ports, meaning more so the folks that work there. Obviously, you guys just went through some pretty big contract negotiations. Not you necessarily, but obviously a lot of the folks who help run the individual sections of those ports. And I am curious about the stability of that workforce if economic times do get tougher.
Well, I would tell you that we had one economist a couple years back or several years back. I'm talking about Paul Bingham, a well-respected economist here in the supply chain industry. He was asked the question, how does he think of the economy? He was basically said, I could tell you how good the economy is in the United States by looking at the numbers of containers that come through the San Pedro Bay complex. So that kind of tells you that, again, if we impact that volume, if we impact that trade relationship, you're going to impact jobs. And then when you impact jobs, then of course you're going to impact that consumer demand and that base of spending that's so important to our gross domestic product.
All right, Mario, that's a good place to end it. Always eloquent, and we always appreciate you taking time for us. Mario Cordero runs the Port of Long Beach out there in California. So.
And of course, we got to recap what happened in trading today, because if you were counting on a recovery, you got that at the open. You got that for the first couple of hours of trading, but it faded pretty quickly. Stocks steadily declined through the trading session. They closed off their lows, but still down 1.5% below that key 5,000 level remain, and really on the cusp of a bear market for the S&P.
Yeah, down 19% from that all-time high. And we talk about where is the support. Remember, we came in today and you had a support line right around 5,040. We opened above that here, but of course closed below it. If you're going into the day tomorrow, the key numbers to really look out for: 50, 70, 85. That's your pivot point. But the main support level is down at 48.74. So that's a long way down. But again, we've broken through some pretty hard support lines already. Honestly.
Yeah, all 7 members of the Mag 7 down, led by Apple. Of course, those tariffs on China set to begin at midnight tonight, up to 104% on the Chinese economy. This is the close on Bloomberg.
Welcome back. It was just about a month ago where several airlines cut their guidance going forward. Some concerns here about weaker travel demand. And tomorrow we finally actually get the exact results. Delta is set to report earnings tomorrow morning. This is as the airline is downgraded, I say, to neutral from buy over at UPS, citing a weaker economy and recession risk. George Ferguson over at Bloomberg Intelligence joins us right now to talk about what we're going to learn. Of course, they already pre-announced or gave us a little bit of a taste of what we could expect on the revenue side for the most recent quarter and going forward. But honestly, the big question, George, is do you think executives are going to have the temerity or the willingness at all to give any sort of firm guidance going forward, given how much turmoil there is right now in the markets and the economy?
It's hard to imagine, right? So I expect that they'll tell us that things have definitely worsened since they lowered guidance for 1Q. So their expectations for 2Q won't even be as good. But my sense is, given all the volatility in the world right now, they're going to be very reticent to give us much guidance of where they think 2Q is going to come out.
They're going to be very reluctant to say very much. Are there any silver linings here? I look at oil prices and how much they've tumbled. Could that be a good news story for these airlines?
I mean, it's absolutely a good news. It won't compensate, I don't think, for the fall off in demand and for what I expect to be decline in yields, which are synonymous with the fares. But this lower price in jet will absolutely help the bottom line. It'll help absorb some of the pain from lower fares.
Yeah, it helps the bottom line, but the top line is what the big question mark is, certainly. George Ferguson of Bloomberg Intelligence, really appreciate your giving us a quick glimpse into what we might expect from Delta. And of course, that comes out tomorrow morning. Sticking with travel, though, our next guest says that tough talk and tariffs are having a real impact. Weaker demand, airline safety incidents, and economic headwinds are all hitting the bottom lines of the airlines. Clint Henderson is managing editor at The Points Guy, and he joins us now. And Clint, given what we've seen over the last 4 days, and if you want to extend it, the last couple of weeks, I'm curious as to how price sensitive consumers have become. Are they still fairly brand agnostic as they had been in the golden travel period after COVID? Or are they becoming a lot more, are they still brand loyal, I should say, or have they become a lot more brand agnostic now?
Well, I think if you see an airline like Delta warning, that's really bad news because they're really the premium carrier. They're where customers have been willing to pay for premium extra legroom seats, even buying up to first class. Just a few months ago, Delta was saying it was going to be a banner year. Now they're saying, whoa, wait a second. So I'm nervous. If Delta is nervous, then that means the other carriers should be very nervous. So, if I'm worried about having a job, am I going to spend for that extra legroom seat, or am I just going to take my regular seat and coach? And that's really where the money's being made for these airlines right now in those upgrades and those upsells. So yeah, I think the airlines and hotels have a lot to be nervous about right now, along with the rest of us, frankly.
Okay, so consumers may trade down from a premium coach to regular coach, but what about business spending? How does that look?
Well, I think the same thing. You're starting to see corporate travel cut back. We had just seen a recovery to pre-pandemic levels, and with government workers being furloughed, they were buying some of those last-minute business tickets, and if that market starts to go away, then that's big trouble for the airlines as well. And the airline stocks have reflected this. You've seen Delta stock down by a third in just a few months. So yeah, it's definitely concerning.
I am curious, Clint. I mean, we've spoken with some travel industry executives who talked about this idea that, at least on the leisure side, a lot of people do book their vacations pretty far in advance. So I'm curious as to how much of that might already be locked in, at least for the next few months. Is that something that investors, for that matter, can maybe sort of hang their hats on?
I do think that's the case, and I think falling oil prices also helps on that front. In fact, with the conflict with Canada, you saw a lot of route reductions and things like that. But a lot of the leisure travelers had already had trips booked, and they're not really going to change, even if there's some new tension at the border. But going forward is what those of us in the business should be paying attention to. That's why the Delta earnings tomorrow will be so interesting to see what their outlook is for the rest of the year, because you won't really start seeing an impact until a little further down the line.
With regards to business travel, I mean, usually, at least just based on my own personal experiences, those trips tend to be booked at the last minute, much to my boss's chagrin. But that is just sort of the way it works for a lot of people in this space. If they cut back, though, meaning companies decide that it's not worth sending so-and-so to wherever ever, is that going to be enough of a material impact for the main U.S. carriers?
Absolutely. And I think that's why you're seeing the decline in stock prices, because there's fears that last minute trip may go away. That's where, the airlines are making most of their money. Tickets are the highest right before the day of travel, because they're counting on those business travelers to book those last minute tickets. So the leisure traveler booked, 6 months ago, but that business traveler is booking last minute, very expensive tickets. And if they're cut back even a little bit, that has a huge influence on the bottom line.
So what does this all mean in the end for fares, Clint? If there's going to be reduced demand for travel, the planes still need to fill their seats. Are we going to get last minute deals, or is that something that the airlines are reluctant to go back to?
I think the airlines are reluctant to go back to it, but they're not going to have a choice if the planes are going out empty. So I do expect you'll see deals. I am waiting to book summer travel for a little bit longer because I think we're going to see some discounts. So there is a silver lining here for passengers who are flexible and can wait to book. I think prices will come down. The truth is, since the pandemic, it's been almost never ending demand. And this is the first time that I've seen any let up at all in demand.
How many outstanding points are there out there in the system, in the ether, where people who still need to travel or want to travel don't want to pay up in cash, but can draw down on some of the points that they've accumulated over these years?
Yeah, so people are sitting, we don't even know how many points are out there in the various programs, but tens and hundreds and billions of miles and points out there in the universe. And yes, I think when cash prices go down, that means points prices also go down, because the airlines have everything tied to dynamic pricing now. So we could see some discounts, not only on cash prices, but also on points prices. So that's something, of course, at the Points Guy, we're very interested in. And if I can get some business class seats that might have gone to a business traveler to London just a few weeks ago, if that seats open up now for points bookings, we may see some erosion in that really high price for points as well.
What's kind of the discount, the percentage discount that you think lures people back? So somebody who maybe is on the fence, not quite sure they want to book that travel, if they see prices come down, kind of what's that threshold that you think would pull them back in?
So 25% is usually, I don't write a deal alert at the Points Guy unless it's 25% or more. So 25-30%, you're starting to see some consumers' ears perk up. And that would certainly interest me more to see a 25% discount.
Clint Henderson, managing editor at the Points Guy. Fascinating stuff. Thank you so much. And at least gives us something to look ahead to. Are you looking to make some last minute bookings here?
No, it's funny. We were having this conversation. We just did a big vacation just a couple of weeks ago. So we hadn't had a chance to really kind of look ahead to the next one. But, having kids and stuff, we always go around breaks and things like that.
Yeah.
I don't know. Maybe this year will be different. Who knows?
And there's some points that are waiting to be used, right?
And there's a question, too, of where you go, right? Given how do I put this delicately? The perception of Americans right now around the world. Do I want to take a trip overseas to Europe or Asia, or do I just say I'm just going to, maybe get in the car and drive to Pennsylvania?
Maybe just tell people you're
upstate.
from Canada.
Okay, I don't know if that's I don't know if I can pass for a Canadian, Scarlet Fu.
Well, we'll work
I'm not
on
nice
that.
enough.
We'll work on that. All
right, we're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg.
You have to say sorry.
It's hard to keep up with the superlatives in the market, but it was another volatile day on Wall Street, and tomorrow could prove to be just as volatile as well. We start off with what to watch over the next 24 hours, and that kicks off at midnight.
Yeah, the higher U.S. tariffs take effect on imports from more than 50 countries and territories. And of course, that follows the April 2nd announcement. But the big one, of course, is 104% tariffs on Chinese goods. The Chinese have not relented. They are ready to take on the United States. And there's been no indication that there's any discussions between Beijing and Washington on this.
Yeah, the president, I should say, actually saying that other countries are willing to negotiate. He said in his words, South Korea and Japan already on the plane here. And the White House press secretary said at least 70 nations have contacted them about negotiations. In addition to that, we have our eye on earnings. We were just talking about Delta, but we're also going to get Constellation Brands. Talk about a company. This is the liquor.
Very much exposed.
Talk about a company exposed to the tariff threat.
Absolutely. They have to deal with tariffs on Mexico, on Europe, and this is going to be something where people are going to look at how much the company actually says about what they can see going forward.
And I love these two. I mean, Delta in the morning, Constellation Brands after the bell. A real nice read here on spending, consumer spending, and I guess to a certain extent business spending, at least with Delta. Maybe Constellation Brands is business spending too? I don't know. Not our kind of business, but anyway, something to keep an eye on, and more importantly, to see what the executives have to say. We are going to get some Fed speak, though. I'm not sure what they're going to say. Tom Barkin is scheduled to speak at 11 a.m. and at 1 p.m. This is going to be interesting, Scarlett.
Yeah, an auction of 10-year notes. We already saw the 3-year auction did not go off great today. There are a lot of concerns now about whether U.S. Treasuries are the risk-free instruments that they once were. Is there going to be a buyer strike? You just look at how much yields moved today. The 10-year yield up almost 11 basis points at the close, but it was big, wild swings throughout the trading day.
4.3%. Jim Bianco says that number needs to come down into the threes. We do get an update of the FOMC meeting minutes at 2 p.m. Eastern time. But take a look at what's been going on in futures here. Still some softness in the market as we close out the close here on this Tuesday afternoon. And take a look at the offshore yuan. That's a record low.
Record low.
This is Bloomberg.